Hey everyone, Mark here, back for another video. Today's video is going to be a little bit different than what you're used to, but it is a video that I'm really excited about. Being involved in the financial world and having a large social media presence, I get a number of common questions. What are the best stocks to buy right now? Is stock X a great buy right now? Should I buy it? Or how should I start investing? The thing is, all three of these questions are great questions without a doubt. But if you've asked me one of the first two, is stock X a good buy? Or what stock should I buy? You've probably gone away a bit disappointed because really I don't answer them. The reason being is I am a CPA but not a financial advisor, meaning I cannot give personal financial investing advice without being a financial advisor. My mission with my business as well across all of my social media platforms is to help educate and empower individual investors to help meet their long-term financial goals. As such, in today's video, we are going to be talking about how to invest your first $1,000. And really this is going to be breaking it down on if I were to start completely fresh right now with just $1,000, and it really can be any amount of money because we're going to look at percentages, but we're going to pick $1,000. But it could be your first $50, your first $100, your first $500, whatever it is. You can follow along on this video, and I'm going to break down how I would build a brand new portfolio from scratch in this video. But to begin, I want to talk about investing in yourself. It is so important to invest in yourself, invest in your knowledge, never stop learning. Investing in yourself is the ultimate investment. That could mean things like books or courses or classes, whatever it may be. If you are furthering yourself and always looking to gain an edge to fully understand not only the financial markets, but this could relate to relationships or your career. There's always something more to learn and gain an edge. And with that being said, here's a quick word from today's sponsor. In today's fast-paced environment that we live in, and skyrocketing education costs, the idea of finishing or just going to college can both seem unrealistic and far too expensive. After all, we are seeing students go to school and then they're drowning in debt for years to come. However, this is where Southern New Hampshire University, or SNHU, comes in. SNHU is one of the largest accredited nonprofit online degree offerings in the country. SNHU is radically affordable, and their online tuition rates are some of the lowest in the nation. No longer does a lack of experience or a specific degree need to hold you back in your career. You can gain that from SNHU at an affordable cost. Go to snhu.edu/Mark, also linked down in the description below, to see what the current average annual salary for a number of different programs that they offer. One of their programs that sparked my interest was the Accounting and Finance online program. So definitely check that out. And again, thank you to SNHU for sponsoring today's video. So number one talks about investing in yourself, investing in your knowledge, and to never stop learning. The importance of understanding the stock market and how it evolves over time cannot go unmentioned in this video. But now let's turn our attention to building out an investment portfolio and investing our first $1,000. So to begin, you always want to focus on building a firm foundation. The same goes for relationships, for your career, and for investing in the stock market. Having a firm foundation to fall back on when times are good and to fall back on when times are bad. And firm foundation, you want to focus on quality and you want to focus on diversification. Right now out there in the stock market, we have tons of volatility that we've seen in 2022. And big time growth stocks, you're seeing them down 70, 80, even 90% for some of these stocks right now. That is not reliable investments. That's why I'm going to focus on my first investment that I'm going to make. I'm going to put 50% of what I'm starting with, so in this case $1,000, we're going to take 50% of that and we're going to put it in a broad-based ETF. Now first let me explain what an ETF is. ETF stands for Exchange Traded Fund. Think of it as a basket of stocks. You have a piece of hundreds or even thousands of stocks out there. So with that 50%, I want to look at something like VTI or VOO. VTI is a total market index ETF. It focuses on every single US public company. VOO, on the other hand, focuses on the S&P 500, and it tracks the S&P 500 index. Not only are ETFs hands-off, but they're also very reliable due to the diversification. You are not relying on just one individual stock that you're investing in. By investing in an ETF, you are relying on hundreds of stocks. So a few of them could have some bad earnings reports, but there's going to be others there that have good earnings report to pick them up. So they weigh each other out, and it's more of a slow moving process. For you to lose all of your money in these ETFs, especially VTI, the entire US stock market would really have to go under. And ETFs can be great because they're going to add reliability, they're going to add diversification, and they're also passively managed. So it's really a hands-off approach to investing. In fact, the great Warren Buffett swears by this hands-off approach to investing.
It makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund, keep buying it through thick and thin, and especially through thin.
So much so that he made a bet in 2007 with 5 hedge funds saying that over a 10-year period, they would not outperform an S&P 500 ETF. The bet was measured net of fees, and in the end, Buffett won by a landslide. The S&P 500 10-year performance was 126%, and the 5 hedge funds had an average performance of just 36.3%. So that right there should tell you all you need to know. ETF investing is a great way to get pieces of hundreds of different investments out there. And that's why we're going to take our first 50% and put it in either VTI or VOO. So now let's get on to the next investment that I'm going to make. And I'm going to take my next 25% and I'm going to get a little bit more specific. ETFs are built in many different ways. We just saw broad-based ETFs with VTI and VOO. ETFs track different sectors. ETFs track stocks based on their market caps. ETFs could be dividend focused or growth focused. And with that next 25%, I'm going to focus on a dividend ETF. And that is the Schwab US Dividend ETF, stock ticker SCHD. SCHD is by far my favorite dividend ETF that's out there right now, as they have a nice dividend yield over 3%, and they also have a 5-year dividend growth rate of 12%. The makeup of the ETF is focused on a broad range of dividend-paying stocks from high yield to dividend growth stocks with lower yields, making it a very well-rounded ETF focusing solely on dividend payers. Being a dividend investor myself, this is by far my favorite ETF. Some of the top positions in SCHD include Merck, Amgen, IBM, PepsiCo, Lockheed Martin, Cisco, Pfizer, Home Depot, and Texas Instruments, as well as Coca-Cola. This ETF has over 100 positions in total. So with SCHD, it is still a broad ETF, but it's focused more on dividend-paying stocks. And not only is it a broad range of dividend stocks, you get a nice yield, you get some growth potential, and you get dividend growth, which is one reason I love SCHD. So now we've taken the first 50% of our $1,000 and put that in something that tracks the S&P 500 or the total market. The next 25% focused on dividend-paying stocks. So now we have 75% that we've used. So with the next 20% of our portfolio, we want to ratchet up the growth trade a little bit more. And that doesn't have to mean growth stocks individually. We can still stick with ETFs. And that's exactly what I'm going to do here. I want to invest my next 20% in something like QQQ, which has a lot of big tech names, some of which you will see in the likes of the S&P 500 or VOO, which we started off with our first 50%. But you're going to have higher exposure, and you're also going to get a lot of stocks that you may not have seen in SCHD. Definitely not a dividend-focused ETF, as QQQ has a dividend yield that is well below 1%. Here's a look at the top 10 positions for QQQ. Apple, Microsoft, Amazon, Tesla, Google, Nvidia, PepsiCo, Costco, and Meta Platforms. QQQ has slightly over 100 positions in its ETF. So now we have our first 50% in a broad-based ETF, VOO or VTI, depending on what you choose. We have our next 25% focusing on dividend stocks. Then we have another 20% focused more on growth with QQQ. So now we're sitting at 95% of our first $1,000 has been spent. So with that final 5%, this is where I like to get more involved with individual stocks, which add a little bit more risk, but with more risk comes the potential for higher rewards as well. Plus, I'm an investor that is in the stock market on a daily basis or at least a weekly basis. I like the idea of investing in individual stocks that I know, individual stocks that I like, and individual stocks that I can relate to. So with that remaining 5%, I'm going to be looking for not only high quality businesses, but companies that are providing and generating strong free cash flows. Companies that just come top of mind include the likes of Johnson & Johnson, Starbucks, Home Depot, or even Costco. So that rounds out our first $1,000. But you may be asking, what's next? Well, what's next is you want to continue to layer into these positions. Continue to take your next $1,000 or your next $500, whatever the number may be, and layer back into these positions, building up your portfolio value. And then from there, you can start mixing things up a little bit. Say with the dividend focused part of your portfolio, maybe you mix in a different dividend focused ETF, the likes of a VYM, which is a high yield dividend, or you can focus more on dividend growth, something like DGRO. With the growth side of your ETF, you already have QQQ and you've already built up a nice position there over time. Maybe you want to focus more on small cap ETF, or you want to focus on a particular sector, say an energy sector or a semiconductor sector, whatever it may be. There are tons of ETFs out there, hundreds and thousands of ETFs that focus on different things that you can look for, but be aware of net expense ratios because fees can really eat in to long-term gains over a long period of time. So that there wraps up our video. And in the comments section down below, let me know how you would build out your portfolio if you were starting today. Make sure you smash that like button down below and subscribe to the channel, as we usually put out 2 videos per week now focused on dividend content. And with that being said, I hope you enjoyed the video and we'll see you next time. Take care.